Lyft reported their latest quarterly figures Tuesday after the market closed, and the stock at the time of making this video is down around 12%. Now you might think, oh, that must have been a horrible quarter. No, actually it was quite a good quarter, just so that guidance was a bit weak. A bit weak when it came to gross bookings. Now, does that warrant a minus 12%? I don't think so. I think the stock, even before the earnings report, was already quite weak. I did a video about that, I think a month or so back. Me personally, I am a big fan of Uber. I'm an investor in Uber now. And Lyft, despite it being the number 2 by quite a long shot, has proven that despite the competition, it can become a better company. And that's why I initially started looking into Lyft. And to be honest, you can have both in your portfolio, right? You can like both, because if both are disconnected, if both are underpriced, then why not buy both? Then, of course, for the long run, it's up to you who you want to keep. Me personally, of course, I'll keep Uber for the long run. And by the way, Uber also went down around 2% because of Lyft. Make it make sense, right? On the one hand, you are punishing Lyft because, well, guidance is a bit weak, might be because of competitive pressures. And then on the other hand, you're basically punishing the competition because a competitor is weaker than you. It doesn't make much sense. So let's talk about that. Let's talk about their comments on the whole AV movement as well, because of course that's also in the discussion here. So we'll discuss all of it in this video. I still believe that with Lyft, you have extreme value here. And I'm not just saying this because, well, the PE is quite low, but if you look at just the growth rate, the expected growth rates, top and bottom lines, you cannot tell me that this stock should be trading so low. By the way, the market cap is now around $5.5 billion, and they announced a $500 million share buyback program, which is around, well, which means they could buy around 9% of the company at the current price. Free cash flow, record free cash flow for the year, and growing. So again, the market is mispricing this one yet again, and I do think that there are opportunities for investors that are willing to go with Lyft and not with other options. So let's discuss all of it. Like, subscribe, all of that. We really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So we'll start off with the main overview here. Gross bookings increased 17% year over year to $16.1 billion. All-time high riders took 828 million rides. That's up 17%. It's their first full year of GAAP profit in the company's history. And adjusted EBITDA margin as a percentage of gross bookings was 2.4% versus 1.6% in 2023. So again, you cannot tell me that these numbers right here, these achievements right here, are achievements of a dying business. Zooming out and looking at quarterly rides, we can see that it has been steadily growing, right? It has been steadily growing since Q1 2023. Yes, previously this was a struggling business, but it does seem like they figured it out. Because if this was not the case, well, then rides would not have increased 15% year over year. Looking at some other metrics here, revenue per active riders also increasing quite nicely since the lows here back in 2023. Number of rides have also increased. Active riders have increased, but of course not that much. So again, yes, if we compare it to Uber, much better company, was also mispriced. I still think that in the 70s, it's still a bit mispriced as well. But Lyft right now under that $13 mark with that 12% hit is now extremely mispriced. Quarterly active riders increased 10% year over year, a small reacceleration from Q3, but it's around flat from the other quarters. When looking at quarterly adjusted EBITDA and margin as a percentage of bookings, that is, yeah, it's true that margin in the last couple of quarters was flat, 2.6%. This is something that we would probably like to see increase, right? We would like to see that increase as adjusted EBITDA becomes bigger and bigger. You would like the margin to increase with that as well. We've seen that with other companies as well and other metrics, right? For example, revenue continues to go up. That's great. But how come the company is not generating more free cash flow? That's because, well, free cash flow margin does not follow the same trend, or at least doesn't stay at the same margin as before. And here, looking at free cash flow in the trailing 12 months, you can see an all-time high and growing. This has been a year that the company did turn a corner, and a pretty big one. So free cash flow in the trailing 12 months, $766 million. And so as for guidance, and this was the, let's say, issue here. So gross bookings coming in at $4.05 to $4.2 billion. That's up 10 to 14% year over year. A small miss there. But they did explain why, and I'll go over that in a second. Adjusted EBITDA between $90 to $95 million, and adjusted EBITDA margin as a percentage of gross bookings, 2.2, 2.3%. So yes, lower than that 2.6%. But remember, Q1 is seasonally a weaker quarter. So during the earnings call, they said the following thing. They talk first about the autonomous opportunity here. So in 2025, you'll see the Lyft platform expand to include autonomous vehicles. This will come to life with our partner May Mobility in Atlanta, which is one of the only two players providing AV rides to the public today. Beyond that, yesterday we announced, this was 2 days ago, they announced a partnership with Marubeni. They'll be the first to use Mobileye, the partner's Lyft-ready AV technology, with the goal of deploying their fleet to thousands of vehicles on the Lyft platform over time, starting in Dallas as early as 2026, with other cities to follow. We're in advanced discussions with a number of other partners. The AV future will have many players across the value chain, including several emerging behind the scenes. They're coming to Lyft. So, okay, some positive comments here with regards to the AV opportunity. Then there was a question with regards to Waymo taking market share, not taking market share. We're all seeing that graph right in San Francisco. And they say that their share in San Francisco remains roughly flat, which means that they did not lose market share there, according to them, which again should be seen as a positive thing. Then they said if you look at Phoenix, they're seeing a little bit of a different dynamic. So in Phoenix, which is another market that's quite aggressively sort of patrolled by AV cars, what you're seeing is our growth is actually faster in Phoenix. So this is very interesting. Our growth is faster in Phoenix than it is across the country. So across the country, we have mid-teens growth. In Phoenix, we're actually seeing it faster there. That's quite interesting. They also said that they see people take a Waymo, try it out, but they don't return as fast as they return to a Lyft ride, which, let's be honest, is normal, right? With new technologies, with new ways to go around, many people are just starting to look at those things, trying it out. It's cool, share it on social media. They like it, they don't like it, and then they just go back to the usual stuff. Moving back to the other topics. So we've talked about that with regards to Uber. So they said with regards to the recent announcement that their partnership with Delta will end on April 7th because Delta is partnering up with Uber. They said the following thing. They expect this will impact their rides and gross bookings year-over-year growth by approximately 1 and 2 percentage points, respectively, starting in Q2 2025. Our long-range plan assumes continued growth driven by our partnership strategy, and this announcement does not change that. So they're definitely going to take a hit from that. They also said that Lyft Black and Lyft SUV rides grew 41% year-on-year in 2024. These are basically premium rides. Then moving on to the media business. Yes, advertising is of course a money-making machine for every business, it seems. We've seen that with Uber, and now Lyft is doing that as well. So with regards to the media business, they said the following. We exited 2024 right on track with that $50 million annualized run rate that we talked about at our Investor Day. And we expect to exit 2025 in the fourth quarter at an annualized run rate at around $100 million. So basically doubling that. And that, of course, will strengthen the bottom line. And so if we go back to what they mentioned during the Investor Day, the 2027 targets. So they see the following. They see gross booking growing at a CAGR of around 15% up until 2027. Adjusted EBITDA margin to reach 4%. Now we're at 2.1, 2.6%. So that 4% is, of course, much, much better. And then free cash flow as a percentage of adjusted EBITDA should be above 90%. Now we're just above 70%. These are the goals, and they're on track to reach that. And the thing with these midterm goals, as long as they do not change them, especially not to the downside, I think there is always going to be an opportunity if the stock continues to get hit based on short-term things. They also said the following. They expect in 2027 gross bookings to reach around $25 billion, adjusted EBITDA of around $1 billion, and then free cash flow of around $900 million, which, to be honest, I expect it to be maybe even closer to $1 billion, if not $1 billion in 2027. So it's trading at around 5.5 times 2027 free cash flow. Really not that expensive in my opinion. Now I'll show you a really quick reverse DCF here. So we plug in the free cash flow for the trailing 12 months. I use the terminal growth rate as the risk-free rate because, again, I don't know what's going to happen. I'm just putting what the market thinks the growth is going to be. The discount rate is basically the terminal growth rate plus the implied risk premium. Then if you want, you can put execution risk. It's up to you. It can go up 1% or so, maybe even more. It's up to you. But right now, I just wanted to show you that currently, just based on these assumptions, the expected growth rate to well justify the today's price is at 0%. And even at 0%, the stock should be 74% higher than it is today. So yeah, that's why I keep saying this is a business that is completely disconnected from reality, especially in the stock market. There is some value here. Of course, me being in Uber, I'm more comfortable owning Uber, but if there is such a big disconnect, why not take the opportunity? Now again, there might be opportunity cost because it might take a while until the stock market notices that Lyft is undervalued, right? And so it's up to you whether you want to take a chance or not. Maybe you want to play the options game. That's also probably a good option, pun intended. Because right now, if we look at the stock, well, we're going to go back down to where it was at the start of the year. The stock did respect the uptrend line, right? Yeah, we did drop a little bit under it, but we made our way back up quite quickly. We were also above the 20, the 50, and the 200-day moving average. RSI was neutral, but now with that 12% drop, we're going to go well below that. So that's a bit of a tricky situation right now. But all in all, if you're looking at it from a long-term perspective or maybe a 1-year trade or so, I mean, yeah, at current valuation with the current growth rate and all of that profitability profile, it becomes very, very difficult to ignore this one. So of course, it's up to you. Plus, Lyft also proves that players like Lyft and Uber are going to exist in a AV world, right? They are partnering up. There are people with fleets and all of that are going to list on these apps. And this basically reinforces my bullish case that I had for Uber. Uber is a big-ish position right now for me. I'm very, very bullish on that. With Lyft, I mean, if it becomes too attractive to ignore, then yeah, maybe I'll just have to open a small position just for the trade. Just for the trade, I do think that 2025 is the year of the contrarian trade. Maybe I'll be proven wrong, but so far I think I've been proven right. So anyways, that's all I've got for you right now. Like, subscribe, all of that, and I'll see you all in the next one. Bye-bye.